Hello. In this video, I'm going to give out a few more dirty little secrets about the trading market. And this applies to any market, crypto, forex, and stocks. The dirty little secret is very simple. You can practice all of the wisdom the experts give you. Pick the right indicators. Follow all of the advice they give you for their award-winning strategies. And still lose money. Why? Well, that starts with looking at the experts. Many experts that give trading advice work for institutionals. And the whole purpose of the institutional is to make money. So if you follow exactly what they give you, simply put, they are making your money by taking it from you. The best trading advice isn't following the strategies they give you, or the magic combinations of Bollinger's and RSI, or stochastic and MACD, or whatever combination they give out. That's actually the worst thing you can do, because then you become predictable and harvestable. And that is what they want. The best way to apply the knowledge they give you is to first realize what they are giving you is a setup for you to be harvested later on. Meaning they will be taking your money because you will follow their instructions to the T, and they know this. This is why this type of nonsense on the chart happens more often than not, and more frequently than it should. These people are harvested. Their money becomes the money of the institutionals because they followed literally to the last detail Bollinger's or MACD or Fibonacci or whatever combination of indicators is available on the market. And it really does not matter. If you stay to standards like the 30-minute time frame or the 1-hour time frame, or if you use a Bollinger Bands with a length of 20 and a deviation of 2, those standards are so predictable that they make you a direct target. That is part of what today's video is going to be about. Understanding how to take a market and an absurd concept and make it profitable. This video is going to be doing completely theoretical, absurd, and yet profitable trading. By now, you should have watched my 6 ways to EMA, where I use momentum in 6 different contexts to provide good and reasonable entries. Now, today I'm going to take that one step further and move into a completely absurd line of thinking. I'm going to take all the concepts, precepts, and training that the experts like to give out, and I'm going to throw it out the door. Today is a day of craziness. I'm going to use RSI in 6 different ways. And in fact, this chart shows you just how profitable that actually is. Now you can see right here from the dollar cost averaging, it gets in, it gets out. It gets in, it gets out. And while I'm here, particularly to this chart, notice I have it set to 29 minutes. Looking at 30 minutes, notice it's a double accumulation. This is not necessarily something I want. Let's zoom in on this area. Okay, so it gets in, gets out, gets back in, gets out. But if I go to the 30-minute, notice there's only one. It gets in, and literally within a few candlesticks, it gets out with a profit. Now, you might argue that the 30-minute is better than the 29-minute, but if you're looking to hedge against harvesting, you want to look at how long you're in the game. 2.5 hours. How long are you exposed? Well, now we got to find it. Here we go. No, actually, no. There we go. How long are you exposed here? So, you see this one is the one the 20-minute shows up. This one gets ignored by the 29-minute one. And look at the exposure. It's profitable, but there's no way of knowing if it would have been profitable once you enter the trade. And that's the thing. Exposure is always better to be limited, even if it means you miss a trade or two in the process, because you will make up the difference in other ways. As you can see, max buys per cycle 1, 13 different trade cycles. Max buys per cycle 2, only 6 trade cycles. More exposure with less trades. 4% profit, 3% profit. Is the extra 1% profit worth the exposure? That's part of your risk assessment. Now, before I get into the craziness of explaining all of these details, let me establish the rules I used for my 6 RSI. Each RSI has to have its own time frame. Each RSI has to have its own length. Let's start with the first one. Here's the primary, here's the confirmation. So my primary length is A13. My confirmation, okay, that's length of 13 and time frame of 3. So the 3-minute candle with a 13 length. That's the primary right here. The confirmation is a 7-minute candle with a 23 length. That's right here. Now in both cases, I want crossover, not traditional. That is, the signal doesn't occur unless it crosses back over the boundary. So when RSI goes downward for a sell, then it triggers. When it goes up over, then it buys. So as you can see, the first RSI, 7 for the time frame of the confirmation, 23 for the length. The primary is 3 and the length is 13. So a 3-minute candle and a 7-minute candle. 3-minute candle, 7-minute candle. Now let's go to number 2. The second RSI combination is a 31-minute candle with a length of 17, a 47-minute candle with a length of 37 is the confirmation. So 47-minute candles for this one, and 31-minute candles for this one. Now notice I'm not changing the overbought, oversold. I don't need to. The fact that I am pulling such strange time frames with such weird lengths is more than enough to scramble the entire recipe and make it unpredictable. For the last one, a 67-minute candle with a length of 13. This should be a length of 17. Actually, let's go 19. Just for the fun of it. We want that different. And of course, an 89-minute candle. And let's give this one a length of 43. Now, all of this is about scrambling these numbers. And that is going to have an impact on the end result. So here you are. Every single length is different. Every single time frame is different. And you can see the results up here. You are taking all of the information the experts give you, and you are applying it in a non-standard way. You are applying it in a way that won't get you harvested. It won't make you a target for being harvested. And notice in this particular recipe, there's not any accumulation thus far on this coin. One purchase, one sell. Now, of course, we're going to go look at other coins, including some lower quality coins. So let's start by going to Binance and go look at some of the standard and low quality coins. And while we are going through these charts, it is important that as you watch these numbers, you understand all of the principles of trading are here. None of the predictability that they teach you is here. So be consistent with the principles, but be very inconsistent with the literal teachings they try to make you stay in. When you're looking at the market, the experts want you on a 30-minute time frame because then you become predictable. The experts want you to use the classic set of indicators because then you become predictable. Once you are predictable, you are harvestable. And that means your money quickly becomes their money. Don't let that happen. Don't be lulled into thinking the information you're getting is always literal. Look at the principles of the teaching, not the actual do this and you'll always make money approach, because you won't. MACD RSI is not the perfect award-winning recipe. It does very well, but following it literally the way they give it to you means they are going to make the money, not you. So let's go through some of these coins. Here we have some accumulation, but still very manageable. Let's see where this leads us. Okay, 2 and 9 cycles. A weak coin, but still very modest accumulations. More modest accumulations with reasonable risk. Then the nightmare coin. Let's open this up. And even on the nightmare coin, it's not very much. More than I would want, but not very much. So the point and purpose of this video, demonstrating the absurdity of using 6 RSI. 1, 2, 3, 4, 5, 6. Now this requires the Pro Plus subscription because you have 4 indicators and 3 linkages. But the absurdity of this highlights the fact that just about any combination will make money. You actually have to really work at losing money most of the time. And most of the time when you do lose money, it's because you've made the choice to take a loss, or because you've ran into a situation that is close to a market apocalypse. It's more likely, though, in all honesty, that you've made the choice to take a loss to get into the market at a better position. Sometimes markets take time to recover, and patience can be difficult, especially when you are living on what you trade. See, from the standpoint of an investor, somebody that's not trading for their livelihood, they're not supporting themselves on their trading income. The market outlook is different. There's a lot less stress. There's a lot less requirements needed. If you're living on what you're trading, meaning you have to have X amount above your break even to pay your bills, buy your food, keep your shelter, the dynamics of your thinking process are very different. And they should not be overshadowed by tactics that institutionals are going to try to use to take your money inappropriately. When you're trading for a living versus trading for retirement, or in my case, a hobby, your thought processes are going to be much, much different. I can take a hard loss and not really worry about it because it's money I've already considered gone. For somebody living on their trading, that's not an option. So this technique gives them the advantage that they can see a market and the harvesting that might go on within that market. As you can see, just by looking at two different time frames, even though they're only 1 minute apart, look how different they look from the trading perspective. Take your teachings and what you've learned from your experts, and don't follow them step by step, but separate the precepts, concepts, and the important parts, the actual education of trading, and learn to apply that in ways specific and unique to you. Trading is as much unique to you as the clothes you wear or the colors you like. Don't become locked into one style or one indicator or one approach. Be dynamic like the market, and you will always stay ahead of the market. Whether you trade for a living or trade as a hobby like I do, both are equally different, but both have one thing in common. Nobody likes to be played the fool and have their money taken from them by somebody that likes to play games like the institutionals do. It's important to understand how that takes place, when that takes place, and how to actually see it on a chart. And it is very visible once you start leaving the common time frames. Don't be afraid to try crazy situations. Don't be afraid to look at the market differently, because that is where you're going to find opportunities that don't otherwise exist. Everybody's told to trade on a 30-minute or the 1 hour or the 4 hour. That is good. That's fine. I look at the 4 hour all the time. But I look at it differently. I look at it in a way where I see just how quickly accumulations occur. This is 4 different positions versus 1 position. We can even go to higher time frames and look at different accumulations. As you can see, this one gets played heavily. But if you were at the 1 hour time frame, you don't see how much the 1 hour time frame gets played until you look at it on a slightly different level. That is the importance about thinking about your trading differently. Differences come in a myriad of ways. Trade safe, trade smart, and beware the harvesters. You'll hear over the next few weeks about how the crypto market is going to crash. I can't count how many experts and enthusiasts I have read flooding Twitter regarding the great crash coming. I don't know if it will or if it won't. And I don't know that it really matters in a scope of looking for opportunities. The goal of trading is to take any market you're given and find opportunity. You're not going to find opportunity by following 15,000 other traders on the same time frame using the same MACD, Bollinger's, Fibonacci sequencing. You're only going to find opportunity by thinking out of the box, by looking at the market differently. Until next time.